Hello, Professor Hunter here. Now that we know the accounting equation, assets equal liabilities plus owner's equity, there are still a few more things that we need to know before we can start writing our journal entries. Definition type items. So one, and we have to start to learn about debits and credits. So one of the most important items is that our debits always have to equal our credits. So you say, well, what is a debit? What is a credit? And if you are in the banking area or just familiar with the banking terms, for now, you want to disregard the definitions that you know about debits and credits. The only definition that you need to know for debit is left side. For credit is right side. This is a T account. It is a representation of the general ledger. You will find that debits are always on the left, credits are always on the right. And so you also need to know how you increase a particular type of account. And the accounts that you increase with a debit are assets, expense, and drawing. And if it helps you to remember, DEA, which could be Drug Enforcement Agency, that might help you to remember that it's assets, expense, and drawing that are all increased with a debit. And the reverse is also true. They are decreased with a credit. The accounts that are increased with a credit are liabilities, revenue, and capital. Capital is the account that the owner's investment in the business is recorded. So liabilities, revenue, and capital are all increased with a credit. So once you get to the point of analyzing and recording transactions, you first have to think, well, what do I want to increase? If I want to increase an asset, I'm going to debit that asset. If I want to increase a liability, I'm going to increase that with a credit. So that's a brief explanation of debits and credits and the normal balance of the type of accounts, as well as what you do to increase them. Bye.